Hey everyone, welcome back. I'm so happy to be with you here once again today. And today I want to just share my part of my personal story with the 7 baby steps that Dave Ramsey teaches, and how I was able to successfully hack step number 6, which I'll explain what step number 6 is in just a minute here. But basically, I wanted to share this video because if you find yourself in a position similar to mine. Back then it was 2018, and I was really looking for a way to. I was just about to come out of a bankruptcy, and I needed to do something to change my mortgage structure. So in 2019, we refinanced, and I dropped my rate. Right, this is what probably Dave Ramsey, a lot of other people may recommend as well. Dropped my rate from almost a 6% all the way down to 3.875. The challenge with that is I started 30 years all over again. So because I already had finished putting, or was really close to putting two of my children, my older children, finished putting them through the college. I had my two younger children here still coming up. I was looking for a way to help speed that process up of paying out the mortgage so that I can, more comfortably be able to do exactly just that. So I discovered this hack and I wanted to share it with you today. But let me just run through the steps according to the 7 baby steps that Dave Ramsey teaches. So if you don't know anything about this, there's a book that's available. It's called The Money Makeover. I read that book a couple of times just to really understand the concepts. And again, it helped me at the time to get a really good handle on debt. But ever since then, I continue to increase my financial knowledge and really helped me to get to the place where I am today. So I thank God for that. But if you don't know what the baby steps are, look on the internet, get that book, you'll learn. Step number 1 is save $1,000. Once you have $1,000 saved up, then he teaches the focus should be on paying off all of your debt. Okay. Step number 3 is after you've paid off your debt, what you want to do is continue to save again, where you have 3 to 6 months of expenses put away in a savings account. Once you have that done, you'll go on to step number 4, which is start to save 15% of your retirement. And Dave Ramsey recommends putting it in a 401k where conservative mutual funds are involved to protect your investment. Step number 5 is save for your kids' college. Step number 6 is pay off your mortgage. And then 7 is live and give. So I was just moving right along with the process. I had actually paid off all my debt during that time between 2019 and 20. And I got to the point where I was saving 15% into my retirement at work. And I started to save as well for the kids' college and pay off mortgage. But when I got there, something didn't feel right, just because some of the things that I recommended, the speed by which those things come to fruition is rather slow. And again, I was 45, 46 years old back then, and I was looking for a quicker way because, again, I had the two younger children that are going to be going to college too. So what I did is I discovered this hack. I discovered this hack to the mortgage to help speed paying off that mortgage in a more efficient and more effective way. And I wanted just to give an example of what that hack. It didn't look like this for me because my numbers were actually different, but this is how it would look like, or can potentially look like, for someone in this particular situation. So here we have someone making $5,500 every single month. Again, that's the income coming in after taxes, so that's net. Now the expenses is $3,700, and of those expenses, there is a mortgage, $2,162.36. Okay, that mortgage, how do we get that? Well, the mortgage is based off a balance that's owed right now, $250,000. That rate is 6.35, and the purchase price was $312,500. Why is that important? Well, according to Dave Ramsey, one of the things that he teaches is get into a 15-year mortgage. But if you can't get into a 15-year mortgage, which would have been a little bit more difficult for this scenario because then possibly would not qualify for the loan, then he suggests, okay, at least put 20% down. So 20% down of the mortgage came from the $85,000, which at that time was in savings. Okay, which means that $22,500 were left because the rest of the down payment they had to put was going toward the $62,500 as a down payment, and that's how we got to the $250,000 in terms of the loan. So moving right along, what happens here is now you still have to take into consideration the other steps that Dave Ramsey talks about. So here we had just gone to baby step number 3. They had saved their 85,000, but they took 22 or 62,500 to put into the loan and buy the home. So now what happens is we're going to be focusing on the next two portions, which is baby steps number 4 and 5. So in baby step number 4, they would have to save 15% to put into the IRA accounts, which we're going to have to take $825 and deduct that from their current cash flow, because 15% is going to be dedicated to savings. Okay. And then he also recommends that you start saving for your kids' college. Now, he doesn't really say how much you should save. He just talks about putting some money aside. Typically, most people that are going to start some kind of college fund for their kids, a very popular one is called the Cover There. And what you're going to do is they'll allow you to put up to $2,000 into that. So if you have, like in this case, 2 kids, right, that means that you're going to be putting away about $4,000 a year. Okay, which that means we're going to put an additional $333 away, so that can get us to baby step number 5 right before paying off the mortgage. Now, if we have $1,800 in cash flow, but we're deducting this, that is going to leave us with $643 and actually $642 of cash flow. Let me just do that right. That's going to leave us with $642 of cash flow, right? So with the Dave Ramsey method, again, he doesn't really clarify how much you should be putting into your mortgage to pay it off. So what I did is I went to calculator.net, and this is how the mortgage breaks up with that particular loan. A purchase price of $312, that particular down payment we talked about, the interest rate at 6.35, and this particular balance, right? So what that does, since they use 62,500 to buy the home, we already know they have what in the home? They have 20%, what's right here, equity. 20% equity. They already had that going in, because that 20% was used, and now they have value. They have equity in the home. Now, if they have $642 left available from their cash flow, they could potentially use that $642 and send it every single month to the payment. Well, if they did that, and if you look at calculator.net, we plug in those numbers, you'll be able to see exactly how much it is that loan over the 30 years, even though they're putting an additional $642, would cost them. So let's look at what that number will be. So I did my calculations here for that particular loan. And if you had this particular loan, at the 30 years, just sending in the extra payments, what's going to happen is the extra payment is going to go toward paying down the principal. You will never see that money that you send to the principal again. As a matter of fact, this is why I encourage my clients, don't do loans. If at all possible, always do a line of credit. We'll talk about how a line of credit is going to make this look like. But sending that extra money in is going to knock off 15 and a half years off. So you would finish the loan in 15.5 years, according to, let's say, the pay off the mortgage as quickly as you can method that Dave Ramsey talks about, because he really doesn't specify how much more you should be sending to the mortgage. So if something comes up along the years that eats away at that $642, obviously you won't have that capacity to be able to pay that. But let's say everything goes hunky-dory, just like life is all perfect for the next 30 years, and he's able to take the $642 and make that extra payment. They'd be done with the loan in 15 and a half years. Now, you may look at it and say, that's almost half the time of a 30-year mortgage. Yes, but what if there's a way, and this is what I discovered, this was the hack that I discovered, that there's a way to do this in half of the time of the 15 years. So if that was a way, would it be something that interests you? I know it interests me when I discovered it. And basically, it's very simple to do because of what the elements that we already have in place. So what do we have in place? Well, we know that equity is already at 20%. We already know that, right? Now, as the years go by, that equity is going to continue to go up because more payments are going to be made toward it. So here's the hack that I discovered. Well, instead of just sending the $642 extra as payments, this is what you can do. Instead of refinancing the loan like a lot of people might be tempted to do when interest rates do finally they start to drop. They can drop. There's talks about them dropping one more time this year, and they may drop a little next year. But instead of waiting for that to happen, well, we already know that we have 20% equity inside of this particular mortgage, or we know we have 20% equity that is available. So we can, instead of doing a refinance, leverage the home equity line of credit. And what you're going to do with the line of credit, you're going to apply for home equity line of credit. And the home equity line of credit will be in the first position. Some banks call it first lien, okay? First lien, first position basically means the same thing. But what would happen then is the 250,000 that is still owed gets put into the home equity line of credit. Now, because they have 20% equity available, we know that the home is at worth at the very least 312,500. At the very least, the home is worth that. So what they can do, and the more logical thing to do, more cost-effective thing to do, would be take the 22,000 from savings, and you're going to put it into you're going to use it and make a payment to the home equity line of credit. What that's going to do is going to drop your balance to $227,500. Now that's the key, and that's the key breaker, because automatically, instead of just having the 22,500 saved in your savings account, which Dave Ramsey will flip about, but what you're doing essentially is you're putting that money to work for you, because realistically, how much money is that 22,500 earning for you? You may have it, if you have it in a bank, it's not earning much, it's probably 0.003. If you have it in a high yield savings account, you may be getting 4.5%, maybe 4%, which you have to pay taxes for at the beginning of the following year. So not the most cost efficient, but putting it into your line of credit, moving this line of credit or moving the loan balance into the line of credit, that means now you're able to make a $22,500 payment. And look at the balance just in one simple month. The balance of the new loan is now $227,500, because you're actually leveraging the line of credit to more quickly and efficiently pay off the loan. So I want to show you just a real quick, simple way to figure out or get a good estimation of how long it would take to pay the loan off at $227,500 with a new line of credit. Well, before we do that, we need to find out what we're getting back as a result of making those moves. So we remember in step number one, the cash flow at that time was $642. So here's the powerful thing about leveraging a line of credit. Inside this $2,162 payment, that is an escrow account. And inside that escrow account, you are sending not just a mortgage payment, which is $1,555. You're also sending payments for your taxes and payments for your homeowner's insurance. Now, the state that I live in, probably in the state you live in as well, we pay taxes twice a year. So does it really make sense for you to send the full amount of taxes to the mortgage company, for them to hold those taxes and then send them to pay them for you 2 times a year? In my opinion, it doesn't make any sense. It's better if I can leverage that money to apply it to paying down the $250,000. That way it speeds up the process. Again, it was the hack for step number 6. Now, he's getting that back. So he's getting the mortgage, or rather the taxes, back. Okay. And then the same thing holds true with the homeowner's insurance. You only have to pay homeowner's insurance one time a year. Actually, if you pay it one time a year, more likely than not, you're going to get a discount. So why have it in an escrow where they hold it for you and then disperse it? You're being charged an extra fee to do that. So again, remember, you have to be smart with the money that we do have available. And in this case, we found a hack for that as well. So we can add that $125 right back to our cash flow, right? So we have 642, 481.77 $125. But here's the big kicker. We also got back the $1,555.59 because instead of that being a separate payment that you're also sending out throughout the course of the month, you are now putting the entirety of this particular payment into your line of credit every single month. And let's look at what that's going to look like. So when we do the math on that, we're actually going to get $2,804.36. This now is your new cash flow. So with that being said, the way for you to figure out when you try this strategy and get a good estimation as to how long it would take for the mortgage to be paid off instead of the 15 and a half years that the Dave Ramsey way shows, right? With throwing the extra $642 in, we're going to see how much quicker this gets done. So a real simple way to do that is take the 227,500 and divide that by the new cash flow. Okay, let's do the math on that. So if we divide 225, 200 by the new cash flow, 2804.36, we get 80 months. 80 months divided by 12, we get an answer of 6.66 years. That is amazing, right? There's a generality that that's going to take, we can say between 6 and 7 years based on the new cash flow. So my question is a simple question to answer. Would you rather it take 15 years or would you rather it take 6.5 years to pay off that particular mortgage? This is how you hack baby step number 6. This is how I was able to hack it, and you can hack it in just the same way. What that does is it frees you up. What do you have when that mortgage is paid off? Well, you have now a line of credit available to you, and that line of credit is going to be in the amount of $250,000. With the $250,000, you can leverage it, right? You can go to vacation. You can put money away for your children's college. You can then take that extravagant trip that you once upon a time you wanted to take. You can leverage it to buy vehicles for you and your family. You can do a whole lot of stuff with it, right? Just be smart about it. But this is the actual way to speed up the process of paying off your mortgage. So you can do it. And I hope this video really helped make it even more clear to you. Now you see how easy this is. I'd like to hear your feedback to see how things have been going with you. If you've been implementing the velocity banking strategy, what questions you have, what fears do you have? I know it could be an intimidating thing, but folks, this is just numbers. These numbers don't lie. So you can do it, put it into place, reach out for help. Be more than happy to help you do that as well. Into the next video, please like, subscribe, and share, and I will see you soon.